Hey, this is Sasha Evdokov, and welcome to another episode of Let's Talk Stocks. And in today's episode, I'd like to just talk a little bit about the events, different kinds of events. There's a lot of discussions about Brexit, but I don't want to just talk about this Brexit ordeal coming up. I want to talk a little bit more about also earnings, which we will have coming up a little bit later. Just the Fed announcements that also happen, and just larger scope events that happen in the marketplace and how you should trade as these events come up. Now, today's video will probably be a little bit more condensed and short. I'm actually on my backup computer right now. Yes, I do have two computers in order to run and manage my trades, and that is a risk management thing. Maybe I'll give you guys a tour a little bit later about the computers and why I have the setup that I have. But for the time being, I'm just going to keep it a little bit short here and just give you some insight about different kinds of events. So as you get into trading more often, and you start watching more of the market day-to-day action, you'll slowly start being aware of the different events that come up in trading. So as you have, for example, the Fed minutes get released, Janet Yellen or the Fed chair starts speaking, you might have earnings that come out, or even things like this that are big where the market talks about it, like Brexit. You slowly start becoming aware of all these potential effects in the marketplace, similar to how, lightning storms also can affect your computer. And this is why, one of the reasons why I have always a second computer. Now, in this case, we have these different events that have effects that happen on your stocks. Even things like Tesla right here that had this event coming out just not too long ago that was going to purchase out Solar City, which had some movement in the stock or the marketplace. So you can see it really moved the Tesla stock much more than the Solar City stock. So these kinds of events are a little bit difficult to control because with a Tesla event, you had no clue that this was happening. It just happened the next day and boom, the stock gets wiped out. So these unexpected events are a little bit more difficult to plan for. So what I always like to say as you're just getting started in trading, one of the best approaches to managing and reducing your risk, and one of the easiest ways until you go ahead and modify it to your own personal liking, is to simply take off half, take off a third, take off a quarter, take off 5%, 10%, 20%, whatever amount you want, in order to reduce and minimize your risk. So even if we're moving in an upward fashion on a stock and it just appears like it's going to the moon, nothing can stop it, that is exactly when you want to take your profits. That is when everybody else is screaming to buy, if you've been in that stock for a little while, that's when you take your profits. Because if you know and understand that the majority of traders lose, and if the majority of traders are positioned on that buy side, when that rug gets ripped out from under you, boom, and the selling starts to happen, then you're in serious trouble. And this is why I always say sell into strength. Into strength, whether you're long the stock, then you would sell it to the upside. And if you're shorting the stock, then you sell it into strength as that stock goes in your favor, and meaning you buying back some of your shares. And that is because you don't know what's going to happen in the marketplace exactly. You never can be sure. You have a probability or chance of success. There's always the statistical probabilities. For example, getting outside of standard deviations, or the probability of a market moving 2 to 3 standard deviations beyond its current price. You do have those probabilities that do play out, but you never really know exactly what's going to happen tomorrow. I mean, you really have kind of a 33.3 chance of success because the market can stand still, it can move up, or it can move down. But really, it's going to move one way or the other. So you could say it's a 50-50 chance. So in order to protect yourself on moves like this that are unexpected, you typically want to sell part of your position or reduce your position size. Now, as you get into events like the Federal Reserve events, so if we look more on the broader scope of the S&P 500, as you get into more of the Federal Reserve events, earnings events, and into other events like this Brexit event that now we have, Those events, you know and understand that they're coming up. These events are coming up soon. And when you have an expected date for those events, unlike the Tesla, which was a little more unexpected, then those kinds of things you can plan for a little bit better. The Tesla events and also things like drug trials where a patient dies, bomb explosions, those kinds of things, it's very tough to plan for. For the events that have some kind of release coming up, they're a little bit easier to plan for. Now, that doesn't mean you won't lose money, or that doesn't mean that the risk is less. It just means that you have an opportunity to plan against that risk. So what's going on as we look into these different events, what I'm always watching is the buy side of things and the sell side of things, as well as how far extended are we. So if we're talking about Brexit here with the UK and the UK leaving the European Union, if we're talking about Brexit, I'm still looking at how people are positioning for that move, but also how they were positioned in the stock market before. Okay, so even though today we may have had a pretty significant rally, about 27 points if you look on the S&P 500, at about a 26-point run here on the S&P, and if you look at the Dow Jones, right around about 230 points. So we're coming into the highs. So today it appears like people are very confident for the move to the upside. Now, the way I like to look at it is what was happening in the past. Okay, so how many traders were trading at that same price level to what direction? So as I start looking across at that same price level, okay, so here, if we look at the spiders, SPY, you can see that we look at the volume, we have about 90.9 million. If you look at the box on the left side of the screen, you'll see that we have 90.9 million shares that were traded, which is a fairly heavy amount in anticipation for this move, one way or the other. But if I look a little bit to the left of that, which was not too recent, right around that same price level, to the downside, there was actually 113.8 million, which was only about a week or two ago. And then I also had 117.7 million also to the downside. So I'm looking and evaluating these different price levels at what was traded and how people were trading at those price levels, because that gives me an indication of how people were positioned in the past. So this could mean a few different things. So as you start looking and watching these things, you're now starting to get into the analysis of, number one, are people positioning in order to cover based on their past position, meaning are they reducing their risk, like we've talked about, selling into strength or taking some profits off? So for the people that were short, is it them taking the profits, or is it actually people getting long into the position? So from my perspective, the way I see it, if you just totally look at volume on its own, just based on the recent week time frame, okay, for the shorter term trading, it appears to me, just from the SPY, of course, that people were actually more so covering rather than actually positioning long or hedging on part of their short, meaning they're concerned that there could be a pop to the upside. Now, of course, doing some more digging, you'll have to dig a little bit more on like the IWM, which trades very heavily. And as you start looking at this, you start seeing a few different things, and you can stretch things out to really get a little bit of a clearer picture. So you can see that even though we had a very significant rally today, again, the last couple of weeks overall, we've only had kind of 3 days. Okay, we had 1 day, 2 days, if you look at it. On June 15th, we've had June 20th and also June 23rd, which is today, of rallies or pops or green days. Overall, between the last, between the last 14 days or 10 trading days, 7 of those were actually red. And if you look at the volume, okay, comparing the last few bars on the bullish days or the green days, the volume was actually lighter. Okay, so what a lot of traders were doing, because we had Janet Yellen speaking, we're actually just waiting. They're waiting patiently, sitting in cash, because cash is also a position. Sometimes you don't need to be in a trade. Instead, it's better to be in cash, waiting for things to evolve, digest, and then you get in it one way or the other, whether you short it at the highs over here at the 118.57 if you're trading the IWM. If you're looking at the rut, you have a few different areas here that you're watching. You have previous swing points at right around 1,200, right around that level. You also have 1,190 also as another few swing point levels there as well. The volume on the rut is a little bit harder to see, so typically I use things like the SPY and the IWM to check the volume. But again, looking at the SPY, you also notice that the volume, the one day that you actually had a little bit of a more of a pop in volume for a bullish day was actually on June 16th, 2016. Now, there's a lot of things that are happening here coming up with the Spanish vote on Sunday. You also have a market rebalancing act tomorrow, and then you have the vote on the Brexit that'll be released. So normally when I get into these events, I typically lighten down on my position, or I try to be very balanced on my positions, either depending on how many positions I have. If I was short, let's just say I was short at these highs, okay, then as we get into more and more events and events start to unfold on events that I am aware of are coming up, I try to be a little more neutral or a little bit balanced, have a few positions to the longs, have a few positions to the shorts. I try to be a little more balanced if I have many positions from before. If I didn't have as many positions from before, I could also, what I can do is reduce some of those positions. Okay, so there's a few ways to approach it. Number one, you can balance them out by putting on a few additional positions, such as right now there were people putting on more bullish bets. Okay, so if there was a lot more shorts, they would go ahead and put on more bullish bets right now to rebalance those things. The other approach is to take some profit. So if there was a lot of shorts, what they would do is they would take some profits, and that would cause stock prices to rise higher. Now, of course, you could be a little more positioned one way or the other, meaning you could just simply be more bullish now because there's a high chance that the Brexit vote that they're actually going to stay. But sometimes here's the problem with positioning that way as well, is what I found over the years is when you actually have everybody on one side. Remember, when everybody is on one side, just like with a teeter-totter or a seesaw, when everybody's on one side, eventually it has to tip the other way because there's just so much weight in the other direction. So you get to that point where when you have everybody being bullish, the market then all of a sudden has to go to the bearish side because you just have such a stretching effect. There's just so much weight that it can only go down, because if everybody's positioned on one side, for sellers to come in, you have to have then selling pressure coming in order to balance it out. It's just a natural way that the market works. And the same thing on the downside. If you have a lot of sellers, okay, just if you take, let's say in January, this major sell-off, if there's so many people on the other side and prices are so far extended to the downside, then all of a sudden, everybody that's selling, let's say 90% of the people were selling. Now you got the rest of the people, or some of the people now stepping in and saying, well, I've already sold and made my profits on the short side. Why don't I step in? And now it's more favorable to actually go long because we're so far away from those highs again. So again, the market's looking for balance. And when you get into these events, you have to always think about your risk and what is really happening underneath the surface. The people on TV, the people on the news, reading reports, all that stuff, you could read it for days, hours, months, years before the event even happens, and it wouldn't really give you an edge. And you might think it does, but most of the time it really just doesn't give you an edge. If you were actually one of the hedge fund managers, maybe, and you were taking polls, let's just say outside of the voting booths or something like that, or you were doing some kind of voting polling before the voting began, and maybe you spent a few $1 million ahead of that in order to do your own research and analyzing the people to get a good estimate of what would happen, then in that case, you might be able to have an edge or advantage. But if you're a retail trader, knowing these things ahead of time is very difficult, whether it comes to earnings, whether it comes to Janet Yellen, whether it comes to Brexit vote, any of these things is just much more difficult. And that is just simply because you don't know which way it's going to go. And a lot of times, even just like with earnings, when earnings are great, sometimes the market or that stock will still sell off. And that is simply because the expectations for the next quarter or the next year get reduced, or maybe because the price was already so high in the stock. And I've seen the other way around, where earnings are bad, but then the expectations look good, or maybe some CEO tweeted out something in a positive manner, so the stock actually goes higher. So just because there's positive news or negative news doesn't mean that things will go to the upside or the downside. Remember, it's about the perception of that news. But as far as trading these types of events, as you get into them, just like what we had with Yellen here and there, normally you want to be lighter on your position. Okay, so for me, I was mostly short there. And then when we get into this area and we start popping and people get a little worried, you start reducing your position. You reduce your position, or you take profits into strength, which is reduction of your position, or you balance out your position. You can do it through hedging. You can do it through options. There's a few different ways. It just depends on the size of your position. If you look at the weekly, again, we're getting to all-time highs. And this is where actually in moments like this, where you can have breaks of these all-time highs, and you may get things like this Brexit deal, new presidential candidate, because what we could do is pop a little bit higher here, pull back a little bit, and then during the presidential race, then break through it. You can get higher prices, but again, we are slightly extended. Relatively, if you look at the volume on the weekly basis, we still have one more trading day to go. And that is something that, you have to take into account, is how have we been coming into this level? And this level has been a very solid resistance level. Can we break it? Absolutely. Absolutely, we can break it. But normally, in order to break something and continue to hold that break, you'd want more volume. Can we get it? We can get it tomorrow. We will see if we get it tomorrow. But you need to watch not just what happens, not just the news, not just what's being said, but how the market reacts to the news. Because it's not about what happened. It's about how the traders act and behave on that news, how the traders act and behave, and how they put their money to play based on those results. So that's really what it comes down to. But as far as for you as a retail trader, as if you're just getting started, if you're kind of new, if you're a beginner, you normally, coming into these kinds of things, you don't want to leverage up because there's going to be a lot of hype. There's a lot of pumping that happens. A lot of people will tell you to buy. A lot of people will tell you to sell. And there's sentiments, because what they're trying to do is they're trying to position themselves. So that way you inflate the prices, and then what they'll do is sometimes as those things pop, they'll sell it into strength. So they want you to do the buying because they've already got in at lower prices. So they're just trying to pump it higher so that way they can get out. So you need to be aware that there's a lot of pumping that happens, a lot of pump and dump kind of things that happen into these kinds of things. And some manipulation, of course, does happen. So just be aware that you really are looking for watching how things react. And normally you want to give it about a good half hour to digest. Normally it'll take for something this large on this scope where it's pretty major, I would say, any kind of thing with the Fed releases, Fed rate hikes, give it a good, 30 minutes, give it a good hour for Fed releases. Earnings, give it a good, day or two. And it really comes down to volume. If you see major volume coming in within that first 20, 30 minutes of that trading day, then you might want to give it a little bit longer, sometimes half a day, sometimes a full day. If in that full day, you see major wide price spread. And by wide price spread, what I'm talking about is when you see major prices moving. Let's take a look here at IWM, for example. Okay, if you see major wide price spread, and wide price spread is something from the lows to the highs. Okay, so if you see a major move from the lows to the highs, kind of like on this bar on February 24th, 2016, then you probably will get a continuation on the second and third day as well. And you'll see what happened here as well. We got a slight continuation here on February 25th. And then the same thing on February 26th, a slight little counter pullback on the 29th, but then further continuation. And you notice that the price spread was wide on a handful of these bars. If you take a look at the SPY as well, and it's not going to happen all the time because it depends on the bigger picture. But let's just look on the weekly, for example. If you have a nice, look at this wide price spread bar on the week of, let's say, March 4th, 2016, you have a wide price spread bar, and then you get, again, continuation and another continuation, a slight little pullback on March 24th, and then, again, a nice bar there. So when you have that, if you have something like that on the daily, you normally then want to give it another 1 or 2 days. Just like when you look at stocks, like individual stocks, like a Tesla, typically you don't have a 1-day move. So once the selling starts kicking in, and if you're starting to break key levels, like let's just say here on Tesla on 4/29/2016, once that initial move and the volume picks up, notice that volume, you'll get maybe a counter trend bounce, but then the stock continues to go in that direction and it slowly starts picking up speed. Okay, so those things take energy. It takes energy to evolve. And the same thing just recently, if you look on Tesla, we had a major sell-off, and then again, you had kind of a follow-through day. There's a lot of action. If you look at LinkedIn not too long ago, when you have those large moves, sometimes because they're so massive, they take time to digest, okay? So they're popped, and then they take time to digest. So that's why it's important that whatever happens tomorrow or any time on events, you give it time to digest. And the amount of time is going to dictate on the massiveness of the move. So on LinkedIn here, when we did a major drop on February 5th, it took time to digest for about 4 months. So it's always going to take a little bit of time for that digestion. Let's just take a look here on FedEx. If we look on the weekly, let's just say here we had a pop on March 18th, and then we had a little digestion. We have a digestion moving sideways. Okay, so there's always room and time to digest depending on the speed of the move. If you have, let's see, SanDisk here, we had some major drops. Okay, so we had one major drop in, let's say, July or 7/18/2014, a little digestion for a few months and a pop, and then again, a drop. Okay, when you have another major drop, talking about March 27th, 2015, we digested. That digestion was slightly upward, but again, this digestion lasted, again, 2.5 months. So the longer or the larger the drop, the move, the pop, the more time it takes to digest. And even when we had a pop here in SanDisk on multiple weeks, that digestion right here, we're digesting it right there. Okay, so knowing and understanding how the energy moves is really important. So I hope this video was helpful and insightful regarding some news and events and just about what to do with your position. For the retail trader, the regular trader, if you have a smaller account, let's just say less than $10-20 million in your account, then you normally want to be a little more balanced on this, reduce your position. If you're trading large, it's a little bit more difficult to make movements and adjustments in your positions because your position will be seen by other hedge funds, and you're going to shift certain stocks around a little bit depending on your position size. But for the retail folks, for the regular people, you want to normally just watch your position size, reduce your position size, be a little more balanced, because those things can whip the market around, and you'll normally get more whipsaw action. You'll have to sit on your hands a little bit, be more patient, glue your hands a little bit down or duct tape them, because you're going to get whipsawed events, whipsawed price action. You get a little bit of a drop and then you get a pop, and it'll be back exactly where it was. So being patient can really be valuable in this business, especially as you get into these events. And it's really just all about watching the risk that you have in front of you and managing that risk by positioning properly based on your account size. So hopefully that was helpful. Thanks for joining me. Enjoy the rest of the week and the weekend. Stay patient on your positions. Watch how things behave and react there that first hour, because remember, it's not just about the news. It's about how traders react and what they do with their money. And then watch the follow through towards the end of the day, how stocks end. Are they ending on a powerful note, or are they ending on weakness? And that'll give you some more insight as well as to where things may be heading. Enjoy the weekend. Remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.